Well, welcome to the Excel in Retirement podcast, where we help good people make wise financial decisions so they can excel in their retirement. Your guide's David Treece, a financial advisor who shares his expertise to help you achieve greater peace of mind about your finances today and have the information you need to create a plan for your future so that you can excel in your retirement. I'm the host of the show, Andy Traub. Today, we're going to look directly at the global headlines. You can't avoid them. We're going to talk about oil and gas prices, tensions in the Middle East, inflation, which seems to be making a comeback. Usually, making a comeback is a good thing, but not when it's inflation. So, today we're going to talk about how to protect your finances and what to do when inflation is here and likely coming more and more. And all the things we talk about today, we've got references to outside articles and sources. So, David, thanks for joining us as always.
Yeah, thanks, Andy. Appreciate it.
So the core conversation people are having right now, energy costs affect, I mean, so many other things. Because
Yeah,
when it costs money to move something, the cost of that something goes up,
right.
and then you've just got the pure energy costs of filling your tank. And so it's creating a lot of volatility. It's creating some very obvious, things cost more right now. Um, But but what's your take on the connection between or what we should expect right now when it comes to inflation? Is it gonna slow down? What are you seeing as you research and understand inflation right now?
Well, as someone that bought a house last year with interest rates being really up, I was really hoping interest rates were going to come down this year so we could refinance that. But I don't expect that to happen now that this war with Iran seems to be prolonging. The expectation now in the markets is that rates, if anything, will go up later this year rather than down. It'll be really interesting to see what happens with the new Federal Reserve chair. Since he's been recently appointed, and he's basically indicated that he would like to drop rates. If we drop rates, that's going to just add to inflation, is the thought process from economists and everyone out there. And so I would expect rates to go up, if anything. Government has been very supportive of the economy and trying to keep unemployment low, really since the Great Recession back in 2008. And so we got really used to the government being really accommodative. And really, the way that they do that is one of the ways is through quantitative easing and buying money and producing more money in the markets. And now that they cannot do that, this is my view, they can't do that anymore because if you create more money or currency, it's going to cause inflation to go up.
Yeah,
So the government
yeah.
is if they do and damned if they don't at this point. And so it feels like Trump has kind of thrown caution to the wind and said, well, we're just going to do the Iran thing and the heck with the consequences. I mean, that's essentially what he said. He said this week that
Yeah.
it's peanuts, these higher gas prices was
Mm.
an indirect quote, but that's basically what he said, and he's not worried about it. And so that's where we're at with people's pain at the pump and so forth.
The irony of someone who's not allowed to drive a car
Right.
saying
It's
saying that gas prices are not a big deal, you know?
right, right.
Um, Now there's a few stats were very interesting as we were preparing for this. There's something called the core personal consumption expenditures,
Yeah.
which is basically an index called the PCE, and it's accelerating. And I was doing some more research on that because that seemed like a very specifically named index. And essentially, what it means is that it is um, all the things that go into consumer cost. It's a index of all the things we buy as consumers minus food and energy because those are volatile things.
Yes.
They could go up by 10 or 20% one way or the other. And so if you take out the sort of outliers, the volatility, then you go, okay, what's left? And that's going up. And
Right.
so you can't say, oh, it's just energy prices or it's just food. It's no, it's everything, you know? And so as an advisor, someone calls you as your clients do and says, David, I'm worried. I'm worried about this environment right now. What would you tell them to do to minimize their worry?
Well, I am very blessed because the way that we're structured in our downside focus first approach We don't field a ton of calls with people being concerned about that. Most of our clients are near retirement or are in retirement, and we have taken a more conservative approach to allocating funds. And so the volatility, we have prepared for that volatility and those swings in the market beforehand. And so when you've prepared for those beforehand, I believe that can help them be less impactful when they actually happen.
Yeah, I got to let me share a quick picture that I think might be helpful to people. I
Sure.
think one of the things that David is saying in his allocations for his clients is to say, let's just say you're on an island, and the closer you stand to the shore, the more you're going to be impacted by the waves.
Right.
Right, the waves come way up, you're like, "Uh-oh." But if you're in the middle where, it's not as treacherous, and so what you're saying is your allocation, the way you run your company, and the way that you take care of your clients is to say, "Let's not be on the outliers where we're affected by the ups and downs as much. Let's sort of move more towards safety in the middle." Is that fair?
Yeah, that's a great analogy. That's a great analogy. It's like you can have a lot of fun riding the waves when you're surfing and things like that. But what I have
Yeah.
found in my experience is that folks that are close to retirement generally aren't worried about that excitement.
Yeah, they are not interested in getting on the, surfboard,
Right,
"Get me
because
off of this
you're
thing."
ready to get sucked under the wave too when you're riding those waves, and that is not fun. Um,
Absolutely.
but yeah, so that's a great analogy though.
Well, let me ask you this. So you've got clients, you've got people that maybe they haven't heard from their advisor in a long time, and they're like, I want to talk to somebody that can walk me through this. Give me some of the core things that you teach people to do. I'm thinking about your green money. About what can you do so that let's just say gas prices go up $1, they go up another dollar, right? What are some things that people can do so that this is very practical, okay?
Yep.
That when you drive out of your driveway and you get down to Main Street and you look at the gas prices, you don't curse. You just go, "Well, it is what it is." And I'm okay with I don't like it, but I'm okay with it because my advisor taught me to make sure that I'm protecting myself from the waves because I've done this. What are you teaching people?
Yeah, when it comes to the green money, what we're advocating for is having 6 to 9 months of budget money. So whatever it takes to pay your bills times nine, and if gas prices go up and suddenly it's costing you 40, 50, 60, $100 more a month, you have the ability to supplement that with your emergency fund for a number of months. And Lord willing, by the time 9 months is done, we're going to see lower gas prices, but who knows? And so that allows you to have more security as opposed to having to put that extra gas money on a credit card or potentially selling your investments at a bad time when they're down and having less money to even use for an emergency. And so
Yeah.
maintain that, that would be ideal.
One quick question about math, and then we'll go to what are the opportunities because of this inflationary environment. One of the things that you make sure that you do with your clients is to make sure they don't have lazy money. And
Yes,
lazy money is essentially that, the tides are changing and you're standing there.
right.
They're slow, but the tide is coming in very slowly, and the tide being inflation, right?
Yes,
Things are going up, 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 up. So if you just looked at the price of things in 1 year, they're going to be up by 4 or 5%. So if your money stayed in the same place, meaning the same amount, meaning 100,000 stayed $100,000, everything else costs now $104,000 because it went up by 4%. Your money lost value. So,
yes.
what are some practical things that you teach your clients and help them manage, along with investments and insurance, all those things? But what are some practical things that if someone's listening, they don't work with you, they go, "Hey, what should I do, David? With I've got cash.
Yeah,
Do I need to put that in the stock market? Do I need to?" And again, I know we're going into advice, but it's like, what's something practical they can do to make sure their money at least keeps up with inflation?
sure. I had a call with some folks earlier this week, and they were sitting on, I think it was 260,000 in the bank, but they had that dry powder because they wanted to buy a house that they had partially inherited from their other siblings from their parents' old house. And so there's times in life where you're going to want to have money in the bank, to be able to buy stuff and so forth. Lazy money is defined as money that does not have a purpose for being there. And
Okay.
so if it's beyond that 9 months or a year of bill paying money, we start getting into that lazy territory. And so it's going to be individualized based on someone's age. But Andy, if someone is in their 50s and they've got extra $100,000 sitting in the bank and they're planning to work for 10, 15, maybe 20 more years, then typically putting it in some sort of market-based investment may be appropriate depending on their risk tolerance and so forth. But of course, we can't broad brush that because everybody's a little bit different. But the stock market can be a great tool to help us keep and up with inflation and retain our purchasing power. And the analogy I always use with folks is it doesn't matter to me if Joe Biden is president or Donald Trump is president when it comes to whether I'm going to brush my teeth and whether I'm going to drink coffee or not. And so it doesn't matter who the president is. I'm going to brush my teeth. So I'm going to go to Target and buy some toothpaste, and I'll go to Starbucks or Dunkin' Donuts to buy some coffee. And so these companies are publicly traded, and so their value continues to go up. We are really fortunate in our country to live with the economy we have. And
Hmm.
anything has been certain since the 2020s started is that our economy is incredibly resilient. And we still, despite all of these challenges with the war and so forth, have great opportunities to make money in the markets and so forth. I think that's been clear.
Yeah. So there are opportunities. And again, this is not the place for specific advice on, where to invest. But I do think that we're just talking about math,
Yes.
that inflation is real and that if you can put your money in an account that has some measure of return versus zero or zero point 0.1 or whatever, to take that opportunity. So the last part of this is looking at an inflationary environment. If you're saying, okay, this is going to happen or isn't, you're in the middle of it. What are the opportunities? What are the good things that can happen when everything starts to get more expensive? It seems like that's bad for everyone. Is that true?
Yeah, I mean, when it comes to stock market investing, you always hear that people want to buy at the top of the market and sell when it's the lowest. But really, you have the opportunity to buy at a discount when the market is down. Fortunately, the market, as of this recording, is still up year to date. Going back, though, real quick to our last point, if you're closer to retirement, though, there are conservative allocations you can make where we can typically make more than a bank CD would make. We've seen a lot of client money come in recently because CD rates are going down and people are looking for
Mm.
alternatives to that. And so you can still be positioned in more conservative allocations and make a return on your money when the market goes up and so forth, or even have guaranteed returns at different allocations. And so there's tons of options, and there's the great thing about the way that we're set up is we have really just about any opportunity there is to invest, I would say. We're
Hmm.
not limited because of the way that we operate as an independent financial planning company. But the opportunities are just to buy and to just maintain what we have going on, I would say. There's more and more discounts that will happen when there's less buyers in there. So for example, if interest rates are 6, 7%, there's going to be less buyers. And so a buyer is going to have more negotiating power over buying
Right.
real estate in a market like this, as opposed to when interest rates were near zero and people are lined up down the road to look at houses. At least that's the way it
Yeah.
was around here.
Yeah. Yeah. I know on a really practical level, there's people in my neighborhood and the houses were going faster. I'm in the Nashville area in the suburbs, and they're having to do more, and so the consumer, the one who's the buyer, has more power now, and that's a change. And so I want to encourage you, if you're overwhelmed by any of this, if you have questions around any of this, reach out to David. You can do that. There's an email address for him in our show notes, and he would love to help you. And then also excelinretirement.com. I'll put that link in the show notes as well, but that's how you can get his weekly newsletters where he talks about events that are going on in the world and how you can stay ahead of them or at least not get behind. David, thank you as always for your time and thanks for your wisdom today.
Thanks, Andy.
Investment advisory services offered through Creative One Wealth, a registered investment advisor. Clients Excel and Creative One Wealth, LLC, are not affiliated. Licensed insurance professional. We are not affiliated with any government agency and do not provide tax or legal advice. Investing involves risk, including possible loss of principal. No investment strategy can ensure a profit or guarantee against losses. Insurance product guarantees are backed by the financial strength and claims paying ability of the issuing company. Investment advisory services are provided in accordance with a fiduciary duty of care and loyalty that includes putting your interests first and disclosing conflicts. Insurance services have a best interest standard, which requires recommendations to be in your best interest. Advisors may receive commission from the sale of insurance and annuity products.